Hi all, this is Akshana Menon from PMS Bazaar. It's a pleasure to welcome you all for today's webinar. Before we're going to talk about markets, I'm sure many would have watched ICICI Men T20 World Cup, India versus England semi-final. Matches like these are a great reminder of how the outcomes can change quickly. One over can shift the momentum, a partnership can stabilize the innings, and sometimes the team that balances stability with timely aggression ends up winning the game. In many ways, markets behave quite similarly. There are phases when the markets are aggressive and trending, and there are phases when it becomes volatile, uncertain, and even range bound. And that's just exactly how even investors should react. Needs a strong core strategy that provides stability while having a flexibility to take a tactical opportunity when the situation demands it. And that brings us perfectly to focus for today's discussion. Today's webinar is centered around core and satellite approach to equity investing. The idea is simple. Building a strong, stable core allocation, often through disciplined index exposure, while complementing with a satellite approach towards the market. Passive investing have evolved significantly over the years. Today, index and ETF strategies are not just low-cost investing. They are increasingly being used as a foundation of well-structured portfolio, even within PMS frameworks. In this session, we will explore how disciplined index exposure combined with active risk monitoring and potentially enhancing the long-term outcomes. We'll also discuss how investors can navigate dull or sideways market, why patience and sometimes knowing when not to buy can be just important as identifying the opportunities, and how risk-reward focused approach in quality index stocks can potentially generate a long-term returns. With that context, let me begin the discussion and to understand how the index-based strategies can effectively implemented in PMS portfolios and how investors can balance stability and opportunity in today's market environment. With that, it's a pleasure for me to welcome the speaker for the day, Swapnil S. Kulkarni, co-founder of PriceBridge. He has 2 decades of experience in wealth management across insurance, mutual funds, AIF, corporates, and FIA treasury management. A special jury nomination at CNBC TV18 Financial Advisor Awards at 2010. So without any delay, let me give the podium to him to explain from his point of view. Before that, I would request the participants to put your questions on the comment box below, and these questions will be taken post this PPT. Over to you, sir.
Thank you, Akshara. Thank you, PMS Bazaar team, for this wonderful opportunity to give us a chance to make a presentation about core and satellite approach. Data is God at Ayan Analytics. So we are a semi-registered portfolio managers with vast experience. We come from different segments of markets. Somebody comes from the regulatory, having worked for indices. Somebody comes from the background of alternate research to classic index and mutual fund managing. So we come with a vast and a diverse experience of multi-decades together. Firstly, let me relate to your investments. I mean, I'm sure we are on the PMS Bazaar platform. So all of us are here after having explored, core investments, our typical core investments into our safety net, which is fixed deposits, mutual funds, and subsequently we move towards portfolio management services to seek more and more returns. Obviously, everybody is in the pursuit of looking for funds which can generate alpha or higher returns. And what happens is typically when we look at return sheets and invest, we often tend to forget to monitor them. We behaviorally have a thought that these investments are fetching me the returns, what the scheme level returns are. So first and foremost, I would like to draw your attention towards your core investments, monitoring them as to how they are doing. Incidentally, this is data which we are presenting from Standards and Poor's. They publish a semi-yearly and annual report wherein they make a comparison of active and passive across the globe. This is pertaining to India. If you look at the slide, incidentally, you will be surprised to know that roughly 85% of active funds underperform their benchmark index over the long run. The ones which outperform the index are not consistent and they do not typically remain at the top. How often do we monitor our fund portfolios, review them, or even if we have a mutual fund distributor or an advisor assisting us, how often are switches suggested as to A fund house or B fund is not doing well, let's move to C. It doesn't often happen. So the net result is that bulk of your core investments are underperforming the markets. So we are of the opinion that, before moving and considering portfolio management services, seeking alpha or, higher returns, our humble request is to fix your core first, strengthen the foundation, avoid performance chasing, and build a core allocation. It is important and crucial to fix the leak. Why should index investing be the core? We are investment managers. Managers may change. Markets remain. Index is permanent. Finally, what happens in an index investment is you are hugging the index minus the cost of the fund, may it be an index fund or for that matter an ETF. So the net resultant is that you are going to generate average long-term returns which a market delivers minus the cost of investing, which is typically low in an index fund or for that matter in an ETF. What does PriceBridge do? We manage passives actively. We call it passively active. Our strategy managing ETFs is PriceBridge Honeycomb. First and foremost, in index investing, we are very well aware that we do not wish to take incremental risk because investors are seeking index returns. So first and foremost, what we ensure is that we keep the beta of our portfolio in line with the benchmark index. We are of the opinion that we need not take additional risk for an incremental return. The objective of this strategy is to help generate a 3 to 5% alpha over the benchmark consistently without any aggressive risk or aggressive calls. How do we do that? We do that through tactical allocation across market caps. There are phases when large caps tend to do better than small or mid caps, or vice versa. More so, sectors are cyclical in nature. A lot of people end up investing in sectors when they have delivered returns. Recent examples could be the crash which we saw in PSU banking or the public sector enterprises or defense stocks. Sector rotation is key. And lastly, if need be, if the heat map or the risk map of the markets are high, we take dynamic asset allocation calls to protect the alpha or for that matter, protect the returns from bleeding. We are primarily an equity-focused ETF offering. We are not multi-asset, while we have kept the flexibility to take exposure to metals like silver and gold, but those would be more of tactical exposures than permanent allocation, wherein we would at all times hold gold or silver, which typical multi-asset funds do. Just a look through into our performances till end of January. February performances are out, but as per SEBI guidelines, we have to post them net of expenses. So we shall share the same with you soon. More than the returns, I would like to take you through the right side of the table, wherein our focus is on keeping the beta lower than that of the benchmark. Keeping the beta low, you can very well see the downside risk or the semi-deviation ratio of ours is in line with the Nifty. Keeping these two or ensuring these two, so far we have generated a roughly 6.8% alpha over and above the Nifty index over the past 3 years. This is annualized alpha. So since inception, we have delivered returns of 18% versus a Nifty return of 13.5. A 3 to 5% alpha is where we begun, is where what our objective is. And we believe that with our skill set of market cap allocation and sector rotation, and more importantly, without compromising on risk, we would more often than not achieve these numbers. Graphically, you may see that for most of the periods, we were hugging the index. The scale is of 1. So what is 0.5% here and there may look very large on the graph. And in a phase where markets have kind of been sideways, challenging, our sector rotation and tactical exposure to metals has generated alpha. I have not covered the stats in the presentation, but just to throw light, our exposure at inception to silver was not more than 5%. It ran up due to rise in price. But more importantly, in the past 1 year, which has passed by, our alpha has also come in from pure equity exposure of sector rotation and market cap rotation. So roughly the 15% alpha in the last 1 year performance is attributed half and half towards our silver exposure and rest towards our equity rotations. These are our top 5 sectors currently. So if you may see, the leader of the rally since the bottoming out of the markets has been financial services or the banking sector. We have a large exposure to that. We have increased exposure to quality momentum small cap ETF. We have some exposure to gold in times of uncertainty, and silver exposures we've been constantly trimming on the rise. So these are our top 5 holdings. Of course, when we talk about investing, there are pros, cons. Pros obviously are, while you are investing in indices, you're certain that your returns are going to be index-like. So one need not bother too much about selection, tracking which fund manager is going to do what, which AMC is going to last, which AMC is going to outperform, etc., etc. Thereby, we sincerely believe that a core allocation should be towards index investing, may it be through exchange traded funds or, for that matter, index funds. What are the cons? Returns in index investing are typically linked to the movement of the index. Performances may get sluggish and it may test your patience during slow and sideways moves in the market. As Akshara mentioned at inception, there are phases when index outperforms stocks. There are also phases when active stock portfolios outperform the index. So we believe one should have the best of the both worlds. That is what core and satellite investing is all about. I would like to take you through what we believe should be a satellite. Presenting PriceBridge upswing. This is our absolute return stock strategy, which is truly flexi-cap in nature. It is crucial to have an absolute return strategy because markets are more sluggish than up and down. It complements index extremely well. In our case, our approach is we build very diverse portfolios in the context of mutual fund. We build 25 to 40 stock portfolios, very similar to that of focus funds of mutual funds. More importantly, how we differentiate ourselves is we build non-model portfolios which are actively managed. The portfolio construct comes from the universe of Nifty 100 index stocks, mid 150 stocks, and small 100 index stocks, which are fundamentally screened. Our objective of delivering a 14 to 22% absolute return is over a 14 to 22% absolute return in annualized terms over the 3 to 4 year investment horizon. How do we achieve? We would like to take you through the same in our subsequent slides. I'm sure most of you would have come across what Roger Federer spoke at a college in 2024. This became pretty viral. Most of you may know this. He mentioned that while he won 80% of the matches that he played, he won only 54% of the points. So it doesn't require too much, is what is evident from the data. So it requires something else to succeed. What is it? So our investing principles in upswing are based on risk reward and hit ratio. To simplify the jargon, 54% is the hit ratio which Roger Federer achieved, winning 80% of the matches. So we track our risk and reward ratios. While we track that, that is a post-mortem. In our vast experience and especially of that of our founder, over the last 25 years, he realized for a desirable output, it is important for an input to be such that it gives this very output. What we do is we are an quantitative fund wherein we ensure that what we buy has to be bought right. We buy only and only if it fits into the 1:2.5 risk reward framework. What it ensures is it ensures capital safety or risk-free return. Anything which does not fit into this ratio would require a significantly high hit ratio, or for that matter, a skewed risk to reward ratio, which is difficult in real world scenario. We built our own order management system with risk controls, wherein no fund manager, neither our CIO nor the principal officer himself can execute trades or investments if it does not define or it does not fit into the predefined risk parameters which I threw light upon. Why do we do this? Because we too are human. System enforces disciplines where emotions may interfere for us and you. There are certain more risk controls which we have levied ourselves. We do not take single stock exposures above 5% at buy levels, and even those are taken in a staggered manner. To take you through our risk reward sheets, we completed 3 years. So I have put up data of few clients who have completed 3 years with us. We incepted in December of 2022. So clients who have incepted with us in December, January, February, March are the ones who have completed 3 years in our PriceBridge upswing strategy. So the demonstration of a 13.5% return, which is on the lower end of our absolute return expectation of the band of 14 to 22 net of expenses. The mantra to this, I would like to draw your attention on the table below on the left, where we have calculated our hit ratio. Our hit ratio in this case has been 58 rights and 42 wrongs. A 1 is to 2.5 risk reward ratio has meant that we have achieved a 14% CAGR return for this given client. Mind you, our observations have been that somewhere around the third and fourth year is which we consistently achieve this mark. I'll share certain more data of some more clients. This is a client who was incepted with us in February of 2023. The returns are roughly 18%. How have we achieved that? The hit ratio continues to remain 58 to 42. The risk reward has improved marginally to 1 is to 3.24, which has made the difference. A client who has been with us since March of 2023 has roughly 18.5% CAGR returns. That has been achieved by a 63% hit ratio to a 37% failure rate with a risk to reward ratio of 1 is to 3.25. With being live in incubation and live as a PMS, we have come to a conclusion that our hit ratios end up being between 60 to 65% at the end of 3 to 4 years, and our hit ratio lies between 1 is to 2.5 to 1 is to 4, which is the success mantra for a 14 to 18% kind of an absolute return, where we essentially are not looking at what the indices are doing, because indices, as I said, are more sluggish than up and down. This complements something like an index investing very, very well, given that it takes the anxiety away when indices are absolutely not doing anything. We spoke about risk and reward ratios. How do we ensure this? So we are a behavioral quantitative approach wherein we have seen these emotions which is greed, self-doubt, worried, high conviction, euphoria. These are day-to-day emotions which we encounter in various facets of our life, whether it is work or whether it is investing. What we have observed is execution matters a lot. More often than not, stock ka khabar comes in around these levels, which is marked as greed and khabri. You can very well read that the risk reward ratio, if one were to enter into an investment here, is inverted. It is 1 is to 0.61. If one enters in at high conviction, it worsens. It's 0.43. Again, an inverted ratio. What we do essentially is we let the greed sink in. Let the greedy ones come into self-doubt. That is when we try and identify and start building positions in a staggered manner such that the risk-reward ratio, if you see here clearly on the markings, is showing as 1 is to 3.2. In the pattern recognition which we have seen over the last 20-25 years in index stocks, if one is patient enough for the self-doubt to set in and initiate buying at those levels, your hit ratio would be anywhere between 60 and 70%. And because the hit ratio is 60 and 70%, you have seen in the previous part of the presentations what a 1 is to 3 risk reward can do. more often than not, it would lead to an absolute return of 14 to 22% without bothering about what markets are doing. This is the crux of the presentation, wherein we have blended our index ETF strategy. We've assigned a 60% weight to that and blended in 40% of our absolute return strategy. So for most parts until 2024, in the earlier phases, we were hugging the index closely. We outperformed in the high conviction to euphoric phase of markets. We fell, and we fell majorly in line with the indices, maybe a few points here and there. And in the sideways markets, while Nifty has made a new high, believe me, many stock portfolios haven't surpassed their peak of 2024. A lot of PMSs, a lot of funds, because the pain is much more beyond what is being seen in the index in individual stocks. The breadth of the market has been poor. The stocks have fallen while index fell 16% in September to February of 24-25. Stocks today, median stocks are down 30% at current levels. So a core and satellite investing has ensured a smoother curve and has ensured index participation and alpha. So that is how, with conviction, we believe that a core and satellite approach of index along with satellite, which could be an absolute return strategy or any of the performing PMSs which you are in pursuit of, should be a satellite portion of the portfolio. My earnest request is to pay attention to the core, which is mostly forgotten about. If you fix that, your overall returns more often than not would get fixed. So with this, I would like to bring an end to the data points which I wish to present. We can take up question and answers, PMS Bazaar team.
Thank you. I think that was quite a short PPT, and it was very well explained as well. So let's while you were explaining about ETFs and about the upswing part and about code, there's one thing that came into my mind is that markets are at bloodbath, and not only that, but also it says that we are getting some stocks at very good valuations now, direct stocks. So why should an investor go for an ETF at this current point of time instead of approaching a direct stock when there is valuations correcting?
Sure. So when we typically refer about index or ETF, what comes to our mind is Nifty. While there are a lot of stocks which are available cheap, so are sectors, so are themes. So at Honeycomb or in Honeycomb, what we practice is not plain vanilla Nifty investing. We are more of market cap guys. We are more of sector guys. That is what ensures what stock portfolios can do. Index investing or ETF investing can do it in a much more index hugging way.
Okay. So, when you said about, you just spoke about sector, and in that way, I'm just going to give a comparison. Like in ETFs, there is index ETFs and one is a sector ETFs. So if we had to compare both, where do you think the alpha drives in? Is it from the index ETF or the sector ETF part?
It is always going to be from the sectors, because sectors are cyclical. And masses, as we said, we are a behavioral quantitative approach. Masses tend to lose the maximum money in sectors, including a lot of fund managers. That is where the opportunity lies, in the cyclicity.
So when you say sectors, now of late, defense ETF had rallied good. We had a lot of people investing into it. So when an investor can directly invest into an ETF like that, why do you need a fund manager or a PMS that handles an ETF at that part?
That's a wonderful question, I believe. Index investing more often than not would lead to index minus cost as the returns. Here we are trying to manage indices put weights to sector indices, market caps, and factor indices as well, wherein we are rearranging our risk. We're trying to bring down the risk in line with index and capture the alpha. So, which also means that when a sector is cyclical, it is equally prudent to exit or reduce exposure to given sectors because the fall is going to be bigger.
When you say about that, sorry to interrupt, you were saying something. When you say about cyclical, I'll say factors are always cyclical. Whichever factors that you take, it's always cyclical. But when you comes into quant as such, there are multiple factors that going to show you that this is going to go well or this is not going to go well. But that's when crowding comes in the picture. So quant as a model, accepts the crowding part of it. So how do you handle that part? I think that's a risk management part that you need to talk about. So how do you handle that?
So we are a behavioral quant. So when I was speaking about grade, quantitative models typically come in at the point of behavioral cycle of grade and high conviction.
Okay.
Which are all-time highs, breakouts. We are contrarian in that sense, where we wish the greed to set in and the fear to take over. That is when more often than not we enter a given sector or a stock or a market cap for that matter.
Just correct me if I'm wrong. So it's a human-driven approach, add on to the quant model. So is that the way it is?
It is the assessment of behavior of the masses in terms of greed, fear, worry and anxiety, high conviction, and euphoria. These are built-in models. So human intervention is not there. Human intervention is there in terms of risk controls of taking weights of given stock.
So who decides the exit part then? Was the model?
Typically, when I said euphoria and high conviction, and a lot of buying sets in, that is where we are suppliers. When fear sets in, that is when we are buyers. So who got greedy, who's fearful, who wishes to exit, we are buyers to them. And somebody who wishes to buy at high conviction and euphoric levels, we are suppliers of a given stock to them at those levels.
So in one of your slide that you mentioned that 3 to 5% alpha above the benchmark. That's what returns that you were talking about. With regards to it, generally when AUM increases and there's a crowding in that. Now, of course, the alpha level that you spoke about, 3 to 5% start to decrease or stagnate at one point of time. So when is that level estimated in your portfolio?
So honestly speaking, in ETFs, we don't see an issue because ETFs essentially are not, they're units created, right? Full of domestic institutions and foreign investments are a market to it. Also, in case of our stocks, we dabble only into index stocks. So this, which you mentioned, holds true for model portfolios which are built around high conviction, fundamentally strong ideas where the supply is bleak. We are in stocks or indices which are traded amply. So we are never going to face the issue of shrinkage in alpha due to increase in size. Just to give you a perspective, the largest PMS in India could be smaller than average mutual fund scheme of the top 5 AMCs which are there. So if we are in the universe or in the space where mutual funds are, so we sincerely believe that we can achieve this mark.
Okay, that's about the industry size as such.
Absolutely.
Okay, fine. When you talk about that, what is the maximum drawdown an investor can expect? Because that is the point that we are in now with the current markets. So where can what is the amount or what is the percentage can an investor expect?
Sure. In geopolitical events which are ongoing currently, risk is there is the risk of circuit, which nobody can eliminate. Once markets are closed, you're praying to the God. So they have to open the next day, open and operate and function. So we would say that we try and reduce the market risk, but we cannot eliminate it. We cannot eliminate it. What we've demonstrated so far is that in our ETF strategy, our drawdown has been in line with the index. In case of upswing, over the last 3 years, there have been various phases of drawdown.
Okay.
In 3 out of 4 occasions, we have fallen less. In the fall which has passed by recently, we fell a tad more. And we fell more not because our beta was higher, but we fell more because we had taken shelter in low volatility stocks. Unfortunately, the fall was driven by foreign FII exit. FII is rest there, so we took a hit. Just to give you a perspective, our drawdown was 23% in upswing.
Okay.
Low volatility index shared the same drawdown as ours.
So we're par with the index then.
We were at par with Nifty low vol index. We were 7% higher than Nifty in case of upswing in the past fall which passed by.
Okay. If you could take some examples, just to say that, for a long-term investor, for a stock would do better in term, a direct stock would do better. And if you're going to convince an participant who was just coming into the PMS industry and going for this ETF-focused PMS, you want to convince him. So it could take some examples. How do you convince him?
So honestly, we are looking at an allocation towards ETF from investors who are invested in regular mutual funds as well as direct mutual funds. Because we saw in the slide which I presented at inception that 85% of the funds underperformed the index. By coming to ETFs, the client ensures that the fees are lower, the returns are in line with the index, and what we are attempting at PriceBridge so far, we should be able to deliver a 3 to 5% alpha over and above the index. So the core portion of one's investment, which typically, PMS comes into one's life typically after having done investments in mutual funds and applied instruments. So we are actually seeking a market share in the core where, investors are invested in mutual funds or, such instruments where bulk of their money lies, and more often than not, those are evaluated only at the point of buying and not being monitored as to what they are doing.
It's more like, well-informed investors. They already have invested in the market. So that don't take much for them to get convinced. So I'll just take one question from the audience as well. From Arun, your advice on allocation of US active ETFs in portfolio against US passive ETFs.
So again, US is in contention because there has been a significant run-up. They have seen a run-up of their life. Last 20 years in US has been a crazy rise. That's when it is into picture. At this point in time, US markets are in a phase of high conviction and euphoria, somewhere in the middle there. So, if you ask us from our standpoint, we would choose maybe an Asia over a US at this juncture. We would go more stock specific into US at this juncture, because all said and done, these companies which are listed in the US are giants. One cannot ignore them.
Okay. For one more question from the same person is that, ETFs at INAV and how efficient they are in India versus US, and how to avoid ending up buying ETFs at the hyped up market rates during times of euphoria.
Never buy ETFs looking at the bid and ask price. Look at the INAV. Liquidity is ample. There is market makers put up by, you name the AMC, you give a market maker spread, which is typically what used to be for creation of units. Not sure how many of the audiences are aware that until recently, even retails could create units. Now those levels have been raised up. I think it's 25 crores. 25 crore and above, you can still create units of ETF. So market maker, all he expects is a spread of that much of creation of units. It's roughly 10 to 15 basis points, and you get the ETF. If you're buying, it's plus 10 to 15 basis point. If you're selling, it is minus 10 to 15 basis point. Liquidity is not a concern at all.
Okay. So just one more question from Hemnath is it a good time to enter smaller mid-cap stocks or MFs now? I think it's a very common question everyone's going to have.
So we see value in quality small and mid cap, whether it is index or whether it is stocks. Yes, I have heard opinions from a lot of CIOs that mid and small caps are expensive, but we see a lot of opportunity in it. If one is doing an index, one is better off. In stock specifics in small and mid cap, there is tons of volatility. If you can put volatility to use as an opportunity, it's a wonderful opportunity to make money as a position trader.
And you say that, silver ETFs had rallied, a few months ago. And then again, it had its drawback. So if even you had your, bit of allocation, silver, gold as such. So what was your lesson from it?
So first and foremost, it rallied and fell.
Yeah.
Where you bought and where you did not buy is very, very important. So we did not buy silver for any of our clients above 1.5 lakh in the initial leg of the rally. And we kept on reducing our exposure to silver. So what we bought as a maximum of 5% of exposure to our AUM went up to 15%. I think we had 3 or 4 rounds of bringing it down from 15 to 10. So we kept on selling on the rise because these are euphoric levels from where silver corrected. As I said, 60 to 70% is the hit ratio when we act on buying at fear levels or selling at euphoric levels. So that's where the fall triggered in. We have a small holding, but it's practically free of cost for us. So we continue to hold it.
So how is the current portfolio looking like? What is the top 2, 3 ETF that, as of now, PriceBridge is into?
So our current portfolio, top 5 holdings, as I shared, were financial services, which has been the leader of the rally. We have second coming in is momentum quality small cap.
Yeah.
We have exposure to gold, which is roughly about 8% on a portfolio level. We have exposure to silver, which is roughly 6% of that portfolio level. And we have 500 quality 50 as an exposure to the portfolio. So these are 5 holdings.
Nothing in gold.
We have 8% exposure to gold currently.
Good. So nothing is in cash.
Oh, we seldom take cash calls. I mean, if there is absolutely no opportunity in the market, it is not a happy space to be in. While I say that, we have made a provision in our disclosure document to hold ample cash. It is provision of 80% in our stock portfolios and 90% in our ETF portfolios. I sincerely pray that those times should not come because those are times of absolute no opportunity in the markets. So we seldom take binary cash calls.
Of course, such opportunity never come to the market. But what was the maximum cash call? Because markets didn't reward for last 1-2 years. So what was the maximum cash call?
So we've gone to about 35% cash levels in upswing. We've gone to a little over 20% cash levels in Honeycomb, that is our ETF portfolio.
It's
but we have been replenished soon. We've not been in cash for long periods of time.
So this human discretion part, right? The taking cash call, it's not from the Quant model.
No, it eventually ends up from the Quant model because if we are selling at high conviction or euphoric levels, and if there is nothing available at sub-grade levels, then we have to sit outside.
Okay. Okay. And there's one question from the audience is that, what are your insights on mid-small cap index funds, financial services, consumption, IT services, and telecom, BFSI offered by Motilal Oswal? I'm just, let me, cut off with, the index part only. Your outlook on mid small cap index funds, financial services, consumption, IT services, telecom, BFSI.
So financial services is in momentum. But taking incremental exposure at these levels would involve high risk. So we are trimming down our exposures at this moment to financial services. We are not holding technology at the moment. We held some as contrarian. We exited before it succumbed. It will take time to bottom out and rise up, is what we personally feel.
Okay.
We see a lot of opportunity in energy. We see a lot of opportunity in public sector enterprises, which does not include PSU banks, because PSU banks have had a crazy run up in the last 1 year. Which were the other sectors which he's seeking advice on or an opinion on?
Consumption, telecom. If you want to answer.
Consumption and FMCG are two sectors which are at attractive valuations. We're dabbling some bit of it in our index fund. We have not yet taken exposure to it on the ETF side. ETF is more of active management. Index is more of medium to long term buy and hold ideas is what we do.
So
For
nothing.
People, we have an index fund, direct index fund offering. Yeah.
Nothing into index now. Nothing in defense now. Sorry.
We have exposure to defense.
Defense. So what is the outlook on defense? That's it, because there are a lot of allocation towards defense ETFs as such.
So as I said, defense ran up and there was a lot of expectations from defense during the election phase of 2024, June, July, August quarter. From there, it saw a big fall. CPSE carries a lot of defense names, right? So we have exposure to public sector enterprises as well as defense standalone, both. We are bullish on the sector.
Okay. Let's just take one more question. Each time in your PMS scheme change underlying ETF, there could be a capital gains liability.
Yes.
This may not be if I invest directly into a single Nifty 50 ETF or for lifetime. So how do you handle this tax disadvantage of PMS?
Honestly, tax is never a disadvantage, is in what we believe in our view. Because if you end up investing in an index, you're never going to generate an alpha. Okay. Because your returns are going to be index minus cost of the fund. Here, if there is alpha generation and you're paying tax, there is no problem. So roughly anything about 2% alpha justifies the churn. Putting rough math.
So what is the churn ratio in this portfolio?
So while we spoke so much, presented so much, we come across as a very high churn kind of people. We've completed 3 years across both our strategies. More than 60 to 70% is long-term capital gains tax. Only 30 to 35% comprises of short-term capital gains tax on either side, on the stock side as well as on the ETF side.
One question from Arun is that why smart beta ETFs, other than the momentum, quality, and value, are not picked up as a part of your portfolio like sector leaders, dividend leaders, Alpha 50?
The question is, they have not run up, right, in the rally currently.
Yes, it's like, why smart beta ETFs, other than this momentum, quality, and value, have not picked up as a part of your portfolio like, sector leaders or dividend leaders or Alpha 50?
So factor ETFs is what I call them. The data is very smart. When you backtest data, more often than not, it will come out to be rosy. In real market scenarios, what happens is these are tactical calls. Not that we did not hold momentum, we replaced momentum with quality. Not that we did not hold, forget a smart beta, something like even a Nifty Next 50. That is one which fell significantly and it has not risen. So these are more of tactical allocation calls when you invest into smart betas. So you have to switch on and switch off exposures to momentum, quality, and you have to keep replacing those with each other in relative terms, which would lead to alpha generation. Holding on to something is hoping on backtested data that the results are going to be similar to what backtesting is suggesting. it is easier said than done.
Okay. Let me talk about ETF as an ecosystem only. So when you say when you take a global ETF standard, the amount of investment made there is humongous when compared to the India ETF. So where do you think there's a gap, and where do you think you need to educate this one particular part to investor who's new to the market?
So in India, we take a lot of cues from what happens in the West. So ETF or index investing in the US picked up primarily after the global financial crisis of 2008, wherein as an investor, you expect an active fund manager to fall less when markets fall and rise more when markets rise. If this given statement doesn't get fulfilled, you're better off taking shelter in ETF or index investing. A lot of people, including me, believed that this will not happen in India when I was young. More than me, the Standards and Poor's data suggests that 85% of India funds in the last 10 years have underperformed the index. The sooner you embrace to index and ETF investing on core part of your portfolio, the better you would be hugging the index. I am not against active allocation to stocks or PMSs because we are ourselves one. But it should be always a satellite allocation because everybody is in pursuit of high yielding, high return yielding, high alpha yielding strategies. We don't know whether it will come out true or not. So it can be 20%, 30%, 40% of your portfolio allocation. By having a 60, 70% core allocation to ETF and index investing, you're definitely sealing the leak first. In pursuit of alpha, underperformance can come in. You have to seal that first.
Okay, these words are from actively a passive fund manager. I think these words are from the from you. And the one more question that I wanted to ask is that when you say this should be a core allocation, just imagine if an investor already invested into a direct stock PMS or a mutual fund PMS and also ETF. So what kind of an allocation should that investor to give to that ETF-based PMS?
It purely depends on his or her goals first. But as I said, one has to monitor into his or own portfolio and figure out the reality. If one is generating alpha and happy being there, so be it. But as data suggests, if this is data of funds, then very seldom it happens so that everything is generating alpha. Alpha is more in the head. You think it is happening. In reality, very few people check whether it is happening or not.
When you start off the PPT, you just start off saying that, data is God. And, data oriented is more into the quant funds. But last 1 year, what happened was the quant funds have underperformed. Not in the benchmark, most of the funds have underperformed. So some have given in -30, -40 returns. So it is not hugging the benchmark, but it is done negatively to the benchmark in spite of, taking momentum or factor-based funding, whatever it is. So in that front, why do someone want to go for a quant-based ETF?
Sure. Quant is a loosely used word. I know of only one person who has used it as a proper noun. It is a common noun otherwise. So what quant does is subjective. We are a behavioral quant ANC, wherein we are more often than not contrarian. Contrarian doesn't necessarily mean value. One can be contrarian in momentum as well. The one who's greedy is fearful. Greed triggers in when there is momentum. It is about execution efficiency. That is what quant is. So we apply quantitative in identification of point of entry, risk reward ratios, and position sizing, which includes entries, exits, trims, everything. So
Okay.
from our perspective, what we practice and preach has been different. Has seen a different outcome to what a lot of quant strategies have faced in the last few years. Quant also includes your factor ETFs. They've bled quite a bit in the last 1 year.
So let me take one question from Arun. Is that BSE 100 versus Nifty 750, a total market. I mean, BSE 1000 versus Nifty 750, the total market cap versus Nifty 500. Which of these indices are ideal for passive investments in a longer run?
Nifty 50 and Nifty 500 are two passive instruments which you should be invested in if you believe in India as a story. Beyond that, anyway, we have driven by market cap. So your large allocation is going to be to companies with larger market cap in any case. So it's going to be meaningless if you go beyond that.
So with that, let me ask you one last question. At this current point of juncture, if an investor is going to step into the market, yeah. So what would be your advice to that particular investor? And the second thing is that if at all, if you want to invest into this ETFs at this point of time, so what advice would you give is that?
So in our behavioral cycle, we stand at the point of fear.
Yeah.
External factors like geopolitical situation would have led to it. We would get worried if the cycle comes to worried. Nobody can eliminate it. But as I said in the past, in a behavioral cycle which is at a point of fear, we are aggressive. So we are fully deployed. So whosoever comes in at this juncture, the funds will get deployed at a decent pace. The behavioral phases of the market also lead to dynamic deployment in our case. So it slowed down in July, August, September of 2024. And we are equally aggressive at this juncture with being vigilant about the geopolitical situation around. If time comes to take a call, we would take it. And again, it would not be a human call. It would come from our behavioral quantitative systems.
So if an investor investing today, I'm just getting it right. So his fund will be fully deployed. This is what I get.
Yes. It will get staggered over
the time.
But yeah, it would not be in cash for 6 months or a year.
Got it. So with that, we have come to the end of the session. I think most of the questions was taken has already been answered. And there are a few questions that are about your fund and management fee, and such of that can be taken offline. So those questions will be mailed to you. I would request you to take some time to get them answered as well.
Certainly.
So thank you for taking time on a Friday evening for the participants as well as the speaker to make to educate each other. Thank you.
Pleasure in mine. Thank you, Akshara. Thank you, PMS Bazaar team. Thank you, audience, for joining in. Hope this was insightful. Thank you so much.